Hello, billionaires. The alarm bells are ringing on Wall Street. You've seen the headlines. You've seen the sea of red in your own portfolio. The market has just experienced one of the sharpest, most aggressive drops in recent memory, a plunge that is drawing comparisons to some of the most volatile periods in market history. The word on everyone's lips is recession, and the fear is palpable. The natural human instinct in a moment like this is to run, to sell, to get to cash and wait for the storm to pass. But what if I told you that is precisely the wrong thing to do? What if I told you that moments of maximum fear are also moments of maximum opportunity? The decisions you make in the midst of this chaos are the ones that will have the greatest impact on your long-term wealth. This is not a time for panic. It is a time for a plan. Today, we are going to cut through the noise. We'll analyze why this is happening, and I will give you a clear, actionable playbook. We'll discuss the types of assets that historically thrive in these conditions, and even name some of the top-tier companies that are now on a massive sale. If you're ready to turn fear into a strategic advantage, this is the masterclass you've been waiting for. Let's get started. To invest rationally, we first have to understand the landscape. This downturn isn't random. It's the result of a convergence of powerful economic forces. First, central banks around the world, including the Federal Reserve, have been forced to maintain higher interest rates for longer than expected to combat persistent inflation. Higher rates act like gravity on the stock market, slowing down the economy and making it more expensive for companies to borrow and grow. Second, we are seeing clear signs of slowing corporate earnings. Major companies, from tech giants to retailers, are revising their future growth forecasts downwards. The market is a forward-looking machine, and it is repricing stocks based on this new reality of slower growth. Finally, geopolitical uncertainty remains a significant headwind, disrupting supply chains and adding a layer of risk that makes investors nervous. When you combine these three factors, higher rates, slowing earnings, and global instability, you get the perfect recipe for a major market correction like the one we're seeing. But here's the critical takeaway. None of this is new. We have seen this cycle play out time and time again throughout history. Economic contractions are a normal, albeit painful, part of the process. And they have always been followed by periods of expansion and new market highs. Understanding this history is the first step to acting rationally. Category 1. The Fortress Balance Sheet. In a recession, cash is king. The companies that survive and thrive are the ones with pristine balance sheets, meaning they have very little debt and massive amounts of cash. They can weather the storm, continue to innovate, and even acquire weaker competitors. A prime example of this archetype is Microsoft, MSFT. It's a cash flow machine with its hands in everything from enterprise software and cloud computing to AI. Its services are deeply embedded in the global economy, making it incredibly resilient. A downturn simply allows you to buy this fortress at a discount. Category 2. The non-negotiable essentials. These are the companies that sell things people need, regardless of the economic climate. Their earnings are non-cyclical, meaning they are less affected by recessions. Think about a company like Procter & Gamble, PG. People don't stop buying toothpaste, laundry detergent, and diapers during a recession. This creates a stable and predictable revenue stream. Another area is healthcare. A giant like Johnson & Johnson, J&J, provides essential medicines and medical devices that are always in demand. These companies provide stability when growth stocks are faltering. Category 3. The generational growth bet. On sale. Recessions are the absolute best time to start or add to a position in the world's most dominant high-growth companies. These are the leaders of the next bull market, and you are being offered a rare chance to buy them at a significant discount. The obvious example here is NVIDIA, NVDA. As the undisputed leader in the AI chip market, it is powering the single biggest technological shift of our generation. While its stock is volatile, buying a company with this level of market dominance during a period of maximum fear is a classic long-term wealth-building move. And finally, the best choice for most investors, a broad market index fund ETF, like the Vanguard S&P 500 ETF, VOO. If you don't want to pick individual companies, this is your answer. You are buying all 500 of the top U.S. companies, including all the ones I just mentioned, at a 20 to 30% discount. It is the simplest, most effective, and safest way to profit from a market crash. Let's address the fears that are likely running through your head right now. Question 1. Is this 2008 all over again? While there are parallels in terms of fear, the underlying fundamentals are very different. The global banking system is far better capitalized than it was in 2008. This appears to be a more classic, cyclical recession, driven by inflation and interest rates, not a systemic financial collapse. Question 2. What if I buy now, and the market falls another 20%? This is a very real possibility. Nobody can time the exact bottom. That's why a strategy like dollar cost averaging is so powerful. You don't invest all your cash at once. You invest a portion now, and you continue to invest at regular intervals as the market moves. If it falls further, your next purchase is simply buying at an even bigger discount. Question 3. Shouldn't I just sell everything and wait for the all-clear signal? Absolutely not. This is the most costly mistake an investor can make. The market's best days often happen in the earliest stages of a recovery, long before the economy feels safe. If you wait for the all-clear from the media, you will have missed the biggest gains. The time to buy is when you're scared to do it. Market crashes are the tuition you pay for long-term wealth. They are scary, they are painful, but they are also the moments that set the foundation for the next decade of growth. You now have a professional-grade playbook. Focus on quality. Look for fortress balance sheets, non-negotiable essentials, and generational growth leaders on sale. And for most, anchor your strategy in a diversified, low-cost index fund. Your action item today is to build your recession buy list. Write down 3 to 5 of the highest quality companies, or ETFs, you would be excited to own for the next 10 years. Having a plan before you act is what separates investors from speculators. If this guide has armed you with a clear strategy to navigate this tough market, please hit that like button. It helps the video reach other investors who are currently being guided by fear. And to continue getting rational, no-hype financial analysis, make sure you are subscribed and have the notification bell on. We will get through this together. Finally, in the comments below, share the #1 company or ETF on your recession buy list. Let's build a community focused on opportunity, not panic. Thank you for your time, stay disciplined,